In 2018, we hired 27,000 people from outside our company. And at the same time, we reskilled in the language that's used today by providing training capabilities and moving people inside the company to another like amount. So we have tremendous access, tremendous view of the markets, and so the hiring is strong. The net headcount changes because the job content changes, but overall we're hiring a lot of people from the market. The people who are leaving us are going to get good jobs and getting promotions places. Maybe the opportunity is not the same from here. Retiring and other things, but it's an interesting play out there. When we look at it overall, when our clients tell us labor markets are very tight, wage growth in our company for everybody that would be 1, 2, 3, 4 times median income or up for the last 10 years in a row has been 6% plus per year in salaries and wage growth. So it's very strong. And we started with $15 in minimum starting wages almost 2.5 years ago now. So it is a tight market. I'm no different from any other employer out there. The good news is we keep bringing people in and training them and getting them ready, and it seems that we're able to maintain a very talented team.
What's going on with mortgages lately? Because last year was kind of a strange one. We actually had GDP grow, but residential investment declined, and part of that's new home construction, but we know rates have gone up a little bit, mortgage applications wilted. Are things looking better here just in the last couple of weeks, or what are you seeing?
Well, we've seen mortgage activity kick back up, and Bank of America, it's never going to change the course of history for us. It's since we changed our position in business, we have about 3% direct-to-consumer market share, but the number of application volumes kicked up nicely as rates have come back down. But back away from just the day-to-day spot, what's going on in mortgages and volumes, the reality is that housing has a lot of investment ahead of it, has a lot of room to run, and household formation, 1 million plus, is solid. So I think you'll see housing continue to be, it's well constructed, the financing's there, it isn't overheated, prices are still moving up, and so I think that's an area that could help extend the recovery, and a lot of people are seeing that. When rates are rising, people got worried, but as rates sort of flattened out and came down, especially the 10-year, and obviously the mortgage plays off that, you saw the expansion. So there'll be ebbs and flows every quarter, weather, whatever, but generally housing is very constructive right now.
And how's loan demand overall? One of the fascinating things has been to watch the Federal Reserve ease monetary conditions so much, to watch those reserves go up so much at banks, but them not to be deployed into the real economy, because for a while there wasn't much loan demand and everything was kind of stagnant. That's been true even lately as growth has picked up a little bit. How's loan demand looking these days across commercial, industrial, and other areas?
The loan demand's pretty consistent where it was, mid-single digits, a little bit better in some businesses, et cetera, so you get trade-offs. But we've driven responsible growth at Bank of America, so we've been pretty consistent in how our loans have grown. I'd say that as you came from 16, 17, 18, you saw commercial loan demand slow down a little bit. You've seen it pick back up, and so that's good. Small business demand, which is loans to maybe $5 million under revenue companies, of which 40% of Bank of America are women-owned, just to keep on the theme of what we're here today. You're seeing that grow faster, more like 9–10%, and it has for several years. So we feel good about general loan demand, but it's going to be consistent with the 2%, 2 to 2.25% growth economy, which is going to be maybe 150, 200 basis points better than that.